So here's another bunch of tips to help you understand the stock markets like a professional, or as I always say, not to trade it like you're a total idiot. Today I want to take you through some of the very basics about mergers and acquisitions, referred to in the trade as M&A. So next time they say M&A, at least you'll know they're talking about mergers and acquisitions. Now this stuff is important because in the long run, apart from being in the right business, the right business which is doing well, it's these transactions that these big companies that are listed do that kind of makes or break them. In other words, a truly dumb deal where they go and spend it all on some transaction which turns out for the worse is going to be a negative breakdown for a company, and something which transforms them and takes them forward could be something that really makes them much, much more interesting as an investment target. And it's not true that all deals are good news. So don't assume that because you hear that some company is doing a transaction, that means that the management team is on top of their game and making progress. Sometimes it's just mad egotism and idiotness that causes these people to do these things. And it's not true that all deals make the share prices go up in the short term. So let's shoot through some of the different kinds of deals you could see. The most common is the common or garden acquisition. So listed company A announces on the stock exchange news service that they're going to be buying privately held company B, which is in their line of business. So a company like Aspen announces they're going to be doing a deal to buy a business in Australia, which is going to be done in a transaction either for shares or for cash. Let's just break those two apart. When they announce they're doing a deal for shares, it means they're giving the sellers of that target business shares in themselves in exchange for the business. That obviously creates more shares in issue, and in exchange, the business that's doing the buying gets the benefit of that additional asset in their business mix. The other way of doing the deal is to do it with cash. And sometimes that's cash that they have in the bank, sometimes it's cash that they borrow from banks under certain terms. The key question to ask yourself when these deals are announced is not, yay, they're doing a deal, this is good news. It's the idea that a new combination has got to result in higher earnings per share over time. So in other words, don't just assume that the transaction is immediately good news. Have a look and see, what are they buying? What kind of earnings has this target company been able to generate in the past? And what is the total amount of dilution, in other words, new shares brought into issue, that's going to be affecting the necessary profit ratios going down the line? And always look and see whether there's scope for the cutting of costs in the combined business, or whether they're all just making that up. They talk about that a lot, synergy costs, but sometimes, in fact, those costs don't really get taken out of the mix at all. The next variation is the conventional buyout and delisting. So we know that in recent months we had that transaction situation with Massmart, and they had a nice little bounce there because, of course, there was the interest from Walmart. Initially, it looked as though they were going to take this thing out in its entirety. In fact, in the end, they only decided they were going to buy half of the business. The stock purchases that are announced of that sort are normally done at a premium to the existing price, and people will say, whoa, is this a good thing? Am I getting some kind of a bargain? In truth, it's not always the case. Sometimes the share price has been terribly depressed, and the buyout deal is merely an opportunity to get a portion of your money back. There's talk in the market at the moment that Metarex is the target of a buyout offer from a foreign party, maybe a Chinese player, maybe one of the big global mining groups. In truth, it could be that that thing is getting us a little bit of a lift. On balance, it could be that if you bought them at the very much higher level, all that's happening now is that they went down, they went back up a bit, now they're being bought out. So not necessarily a good thing, but certainly a good thing if you only entered the trade just a few days ago. The final transaction option that I want to talk about is the dreaded all-stock merger. And this is a case where one company, whether it's hostile or not, announces that it's buying another and merging together with that one, and that they're going to form a new combined whole. Quite common in the US market, a little bit less common here. The normal rule of thumb with these is that the target company's share price goes up and the party doing the buying share price goes down. So be careful.